Hello, folks, and welcome to your Onchain update for the 9th of December. So I'm back in the saddle, still a little bit crook, but good enough to go through a confluence model. So we've looked at this a couple of times in the past. What we're really trying to assess here is across many facets of on-chain analytics, across all sorts of different characteristics, on-chain activity, profitability, all these things. We're looking for multiple metrics in multiple categories, all telling us the same story. And really what we're looking for here is a change in character, a macro shift in the market. So what we're looking for is an on-chain confluence. Now, remember, we're looking at this whole thing from within the context of a massive deleveraging event that's occurred. There's still all sorts of chaos that can happen in the world around it, right? Macroeconomics and stock markets and all this type of thing. And there's two schools of thoughts. There's the school of thought saying that we're headed for a god-awful recession, which I do believe is probably going to happen. And that seriously cannot be good for equities. And as a result of it not being good for equities, Bitcoin's going to recorrelate and away it goes down to zero. That's where I deviate. I actually look at that recession that's coming, and I believe Bitcoin is the forward-looking indicator, forward-looking asset, and fastest thing to respond to any kind of excess liquidity. And I just simply do not believe that the Fed is going to allow the depression that I think is probably on the horizon to happen. I think that the net result of this will be money printer goes brr. And I'm actually not even in the camp where I think that's the only thing that's required for Bitcoin to achieve any kind of escape velocity, although it may be in the initial sense. I think it's essentially what it's there to do is to protect you and protect people from debasement. But I do believe that the debasement is essentially guaranteed. Just the sheer amount of debt that needs to be issued. There's far few buyers of US Treasuries now than there were before. I just think that we're headed into an era where commodities, sound money, and Bitcoin are going to do extremely well, and I think the market will start front running that. Now, that does not mean up. That means that the market starts to stabilize and form some kind of accumulation range. This could take years. This actually could take about a year, much the same as 2019. 2019 and even 2015 was a year-long consolidation period following all the chaos of the bear. Once you hit seller exhaustion, you have to go through that reaccumulation period, and there will be sellers on the way up. So it's going to be a long, slow grind back. But I personally, I feel like we're at the position where I think there's a higher chance than not. By some magnitude, actually, I would probably give it like 75% odds that a bottom is in. And I've said this before, I do believe the current price action is actually still part of our previous bottom formation pattern. So that first sell-off in June that took us down to 17.5, I personally believe this is all part of that same structure. Nothing has changed in the overall behavior. We just have one less scam exchange in the mix and a couple of burnt folks in the market. Aside from that, everything looks more or less the same. So let's go into it. So some of you will remember this model. This is this confluence model, and it looks at it across 4 different aspects, and we'll look at these in varying levels of detail. But as you can see, what this thing does try to pick up is there's these different colored bars. Each one of these aligns with pricing, on-chain activity, profitability, and balance of wealth in the system. So kind of supply dynamics. And obviously, when more of those trigger, the signal gets higher. And the more of them that trigger, when you get the purple bars, that's essentially saying that they're all firing at once. And as you'll probably notice, they all fire at once near tops. And we generally get some kind of reversion back to a blue zone after a period of white when you start to get into some kind of bull trend. Now, what my threshold here is, and again, some of this stuff is arbitrary. There's 8 different signals in here, 2 in each category. The light blue will go off when this thing goes 5 out of 8, and the dark blue will be when all 8 are triggering. Now, as you can see, we've got a little bit of action. Let's just zoom in on our last couple of years. You can see we have a little bit of an uplift going on in recent weeks. Now, it's not the strongest. There's only a handful of bars. These bars will also only trigger when both of the signals in them are firing. So at the moment, we only have on-chain activity that's picked up, and it's actually dropped off on the fee component. But anyway, we'll look at this in terms of the bits and pieces of it. But this is essentially the structure, what we can see at the moment. There is some momentum, but we are not signaling anything too strong. So again, time to just pay attention, not time to be jumping in and doing anything too rash just yet. Just time to keep a sharp eye out. Now, starting with the pricing models, these have been designed to be fairly rudimentary, right? So now, that doesn't mean that they're not useful. They're actually bloody useful. And a lot of people try to overcomplicate things. People 15,000 different models on. The reason they're simple is because they're useful and they're really, really effective and they just do the job. So First signal, which we don't have either of them firing, is our pricing models. Are we above the realized price? No, it's currently at 20,000. Are we above the 200-day moving average? No, it's currently at 21,000. Now, that's the most observed technical indicator in the world, 200-day, and I would say the most observed on-chain model, the realized price. When we break above both of those, probably a good sign. Until we do that, yeah, not so much. Now, before I jump on, just to add a little bit of nuance to that, for some reason, this model has broken. 1 second. We also have another variant of this model, which me and my guys are currently working through at the moment. But we're looking for interesting crossovers. So what this particular model is looking at is we looked at what level of the supply needs to be held by long-term holders, just 0 to 100%, during bottoms, right? How much do you need to get to the point where long-term holders own everything, right? How much do they need to own to put a bottom in? And what we found is about 70%. So most bear markets get put in with long-term holders with about 70%. So therefore, if long-term holders own 70%, let's just do a really, really rough estimation. Say, well, what's 70% of the realized price? What's that cost basis? And what we actually see is that that's what this red line here is. This is 70% of the realized price, just reflecting the general weighting towards those long-term holders who put bottoms in. Now, you've then also got the 200-day moving average, although here we've applied a 0.6 multiplier. Why? Because generally speaking, price will, that's the blue line, it will only fall below it in very, very rare circumstances. Now, what we've then got is periods of time. The dark blue is really the area that we care about. These two models, as you can see, the 200-day moving average times 0.6, or that kind of 10%, I think it's about 10% probability of hitting. When that dives down below the red curve, which is our long-term holder realized price weighting, what we're basically looking at is that process is very, very uncommon. It's where both of these models are very deviated from their, these are high deviations, right? So we're talking about very, very few times as price intersect with these models. And what we're seeing is that generally these two crossover and fire towards late stage bears. You can see it back here in 2012. You can see it here in 2015. You can see it here in 2018. Now, as you can see, we essentially have that very, very same level. So when you get that initial shock wave where price breaks down below the Mayer multiple band, that's basically telling you that, all right, well, now we're pretty far away from the norm. We're seriously stretched away from that thing. So that's what these light blue bars are showing when we have a critical deviation away from that particular model. And the dark blue is showing when those two models actually converge and one dives down below by a certain magnitude. And what we're basically seeing is that within those pricing models, even though the base level models we're currently below them, they're kind of confirmation to break above. These ones here are much more about bottom formation. When do we see that the market is just too oversold? Now, again, that does not mean all-time high is coming tomorrow, but what it does mean is that the conditions and the amount of deviation from those models that we are seeing right now, it just doesn't happen very often. And when it does happen, with the few sample sizes that we have, it's typically near the bottom, which is not a bad way to look at things. So again, we're looking for confluence, just trying to put things, lots and lots of models in our favor. So moving into the on-chain activity space, this is one of them that is firing new address momentum. We have now had about, this will be about a month where the monthly is trading up and above the yearly moving average. Now, we had a very brief fleeting bounce above on fees. Let me actually jump across to the on-chain activity breakdown. You can see that we had both of them fire, but only very briefly. We've now only got 1 out of 3, which is our new address momentum. The other one, which is absolutely just, it's just horrific, is transfer volume. Transfer volume is horrific. It's just so bad, I don't even know what else to say. This one here is telling you the amount of volume moving around on chain is dismal, abysmal, and nothing to be even remotely impressed about. So, to be quite frank, it's a more bearish signal than not. Even though we're looking only, these are all designed to be bull to bear transitions, this one here is signaling not so great. So again, patience is going to be your friend. We only have new address momentum signaling. If we get above these models, however, 20K, 21K, maybe you start to see all those things pick up. Until then, nothing to write home about. Now, profitability. These ones here are looking at, is the market realizing profit? Now, you can probably hazard a guess that we're not. These ones here have a 30-day moving average applied to them because I care about kind of the macro trend. You can see that we're still down at relatively low levels. That said, these low levels do signal bottoms. Now, again, this dashboard is not designed to track bottoms, but also we can also look at these things and go, it looks like previous bottoms. So we can at least take that piece of information away as a sideline character. So both the ASOPA model, which is saying that the average coin that's being spent, how much profit is it locking in? Right now, it's locking in not much on a 30-day moving average. So this is a slower model, but we're looking for that macro confirmation. We're not here for bottom picking. What we're looking for is a sustainable reversal back to the upside. And the other one is our P&L ratio. This is modeling how much profit to loss there is in the system. Same story. So right now, neither of these are following. These are slower to react. We will not be on the bottom. We'll probably actually be outside the bottoming range when these fire. Nevertheless, for most people, that's more than fine. For most people, there is, again, this is from there is no prize for winning the or catching the very bottom, right? Generally, you have a lot of cut hands from trying to catch falling knives. Waiting for that full-scale reversal is generally the best strategy for a lot of people, unless those who are basically dollar cost averaging, in which case you're looking for value, of which many of these typically signal that there is value. Now, onto the supply side of the equation. I have two models here. The first one is the R-HODL multiple. Now, this one here you can see has started to fire off of late. Now, what this one is looking at is the wealth transfer from old hands to new hands. Now, some of this will trigger during March 2020 style capitulation style events because you're seeing that there's a wealth transfer from old hands to new hands. This is capitulation. You are basically seeing that you have people who are capitulating out, who've held their coins for a long time. Those folks are transferring their wealth to new buyers. Now, you see that in bulls and bears, capitulation events and euphoria. Here, it looks more like a capitulation event, but remember, the bottoms are put in, right? Bull markets start at the literal bottom tick of the bear market. So these things tend to go in cycles. So we've started to see a reversal in this sense, which means there was a bit of an expulsion of older hands. I actually want this signal to turn off briefly, unless we get some positive momentum to the upside. If we get upside momentum and old hands sell into it, that's a good sign. It means you have demand coming in to buy those coins. If you don't, then you're probably going to have a bear market rally. So you can start to frame this thing up a bit. And the last one is the supply and profit trend. Now, this is a little bit of a derivative of price, but the way that this thing works, think about the amount of supply and profit, just BTC that was purchased at a lower price. Now, this model is really good because what we're looking for is the 30-day trend. I've put it there's a long-term moving average on it, so it goes nice and linear, as you can see. And then what we also do is I'm looking for when is that longer-term moving average in an uptrend or a downtrend. Now, it sounds like a bit of a mouthful, but essentially when lots of people sell the top, a small drop in price puts all those coins back into a loss, and thus you get a very, very quick, look in 2017, a very rapid trend reversal. In fact, it's slowed down significantly. Look at this trend. The trend here is clearly bullish, right? You have positive price momentum. Coins are continuing to go into profit. When they're going into profit, it means they're not being sold at the top and then prices falling below them. So there's lots of hodled coins below cost basis. Note how its price goes parabolic, but this model slows down. That's because coins are getting distributed at heavier and heavier rates, and every pullback, every tiny pullback in price is putting those coins back into an unrealized loss. People are starting to buy the top. That's what that signal is telling us. Look at it here again. You can see how it really slows down, right? That's people selling the top. Now, you can also see that when it reverses quickly. So what we're looking for is a sharp reversal back to the upside. We don't have it yet, but it's starting to really curl down and you're getting that same behavior. A bottoming out formation, which then starts to move higher. So slowing down is good, but we're not there yet. So anyway, hopefully that's a useful snapshot overview. Again, we're looking for confluence across many things. We've got a lot of bottom signals. We've got a lot of bottom formation signals. But for any of you who've been around through a bear market bottom, they are brutal. We've been in one, I think, for 6 months, and it's bloody brutal. So what happens is you get chopped up, and you get impatient, and your buy levels get tested, and you're just like, oh man, it's taxing. So if you're looking for something to just fully reverse and then feel the confidence that this thing's actually going to have some momentum to the upside, this is the type of system that we can use. Right now, we've got keep an eye on things, but there's no urgency or rush just yet. So sit tight. Let's see how this goes. Key levels where we'll actually come back and revisit this if we do get some kind of major pop is if we get above 20K, we're above the realized price. That's starting to be an excitement generator. You may start to get some kind of momentum that all these things start to reverse back to the other side because we know the foundation's being poured. We know there's a lot of coins being accumulated down here, but the floor has to get put in at some point, right? We don't know when it is, but that's what we're looking at. Anyway, hope that's a useful session. See you in the next one. Cheers.